more. But kind of looking at economics 101, it's very general that price, again, price versus value. Price is basically where a buyer meets a seller. So a buyer makes it, I'm willing to pay this much, and a seller says, I'm willing to sell this at this much. That agreement is where price comes into play. That's what determines stock prices. That's what determines a whole lot of prices. And it depends on the population, how big of a group of buyers, how big of a group of sellers. But the intersection of those two will determine how much is sold and at what price. During those periods of drought, those buyers become fewer, and so that price drops. And so people are trying to sell it, but now there's fewer buyers, and so now the sellers are like, okay, I'll sell things to you at at a lower price because now there's fewer buyers. And that's where that kind of low price scenario is. But again, this comes back to the great question of the difference between cheap and a kind of a bargain. I mean, you can go to Walmart and buy a lot of things for a very low price, but are they going to last? And that's, again, trying to find value beyond just looking at price. And that's certainly a significant thing that we have to go through as a company and in an investment philosophy, trying to seek out that type of value. And price tells us a story, but sometimes price can be wrong. Everyone has their story about going to garage sales and finding something that's they bought on, just like Antique Roadshow. I mean, everyone has their value story, or everyone's heard of one. But we try and import that into the investing sector. That's what we're looking for, imperfections in that marketplace that would give us a mispriced security. And this is where, Steve, I'm going to let you kind of talk through, okay, that's easy, right? I want value. I don't want something cheap. But how do you do that?
Yeah, I think going back just a little bit, when we were talking about that supply and demand ultimately equals price, most things, all things equal, that's going to work in the case of supply and demand. It particularly works when we talk about fixed income debt instruments that are contractual arrangements between the issuing company and the investor. When the demand goes down, as it was in 2008, a crisis, a panic, those types of contracts went down irregardless of the fact that nothing really has changed other than the economic outlook. Of course, a value investor, all things equal, there really hadn't been anything that changed in the face of that company per se, other than, again, economic environment. Well, you step in as an investor in those securities. Now, when it comes to equities in that same scenario, there could be some things that might have been changed. There could be management changes. There could be product antiquation. The product could be antiquated. It could be the balance sheet atrophied in a severe downturn. So as Robert mentioned, is it a cheap price or is it a real attractive value? So we'll work through those metrics, visiting the company, et cetera. All that works into the opportunity of whether or not we step in. With regards to the analyzing of a company financials, value investors, you're going to start with the real assets and or liabilities of a company, the balance sheet. We talk about assets. The most visible asset of a company is their cash position, their receivables, the things that are turned to cash in very short order. We look at replacement costs of plant, property, and equipment if they've been amortized properly, and if in fact to replace those assets are worth, it would cost even more. We look at on off-balance sheet items. We don't really spend a whole lot of time, but many times companies completely write off their assets due to what generally accepted accounting principles allow you to. But one of the perfect examples of this was back in the mid-90s. We were looking at some drilling companies, and as you know from that screen earlier, the oil industry went through a horrific retooling, or not retooling, but a complete restructuring of many companies. They went out of business or they were spun off. But a lot of these drillers that we were looking at had written off their drilling equipment, really written off of many valuable assets on a balance sheet. Unless you spoke to the CFO, spoke to the CEO, and said, hey, what do you have here? And we went down to a couple different ones down in Texas, and they had warehouses of assets that were written off. Brand new equipment, drilling equipment that was stacked, and $20, $30 million that was not on the balance sheet but was written off. So it's more than just what's in an annual report that we have to look at. Those are the margin of safety, so to speak, as some people like to allude to and when they talk about their investment style. We take a great deal of pride in looking at a balance sheet. Obviously, the P&L, the income statement is important, but unlike a lot of people, I don't dwell, a value proposition doesn't dwell on high revenues or high profits. We look at growing revenues and narrowing of losses if that was the case in a company that was losing money. We don't think most of the investment public doesn't look at companies that have either a small revenue base that's growing or companies that are losing money. For some reason, it's off screens, whatever it may be. Human psychology, it's either a crappy company or they're not doing really well. And when in fact some of your major companies come from that area. Take a look at Apple Computer about 13 years ago, what they were doing. They weren't making money. But these are important for us because we like to look at trends. We like to look at things that have been consistently happening after visiting with the company, after visiting looking at the balance sheet, looking at the margin of safety. Okay, what is the business model? The business model is, in fact, that income statement and ultimately that cash flow statement, which is the next one over there. Can they generate cash from their operation? Are they successfully spending it on growing the business as well? For most of the last 4 or 5 years, you can buy debt of many of our companies that are selling at 65 cents, all the way from 25 cents to 65 cents. That bond typically has to recover before you see much appreciation in the stock. It doesn't have to happen that way, and it's also a risk reward. If I buy a bond at 70 cents and the stock's at 5, but I think the stock can be $25, why do I want to spend my time in a bond? And we don't do that. There are instances out there right now where, because of Moody's, rates at double B, single B, yet the company is recovering and it has shown past success. It's more attractive from what we know of the balance sheet that they'll recover, and the upside is in the stock. So it's a risk-reward ratio, basically. However, when you went back into the credit crisis, the onset of that, through the end of 07, and particularly in 08, when the Bear Stearns thing started to kick in, bonds started, the financial machine out there was starting to freeze. People quit doing things. The runs on the banks, etc. Even though the stocks came off, the bonds came out as much or more in some cases. And because the economic outlook is so uncertain, it was a better risk reward to buy the bond, get paid to wait, get that coupon. The bonds may or may not recover, but if they don't recover, the stock sure wouldn't have recovered, because ultimately, if the stock is worthless, the bonds are going to come in and take the business model. We've had a couple cases where that has happened. I don't want to get too granular with names, but it has to do with the macro picture, secular position of the stock market, and the cyclical position as well. Where are we in the marketplace right now, and is it better to be in equities? Is it better to be in bonds? Obviously, the Federal Reserve Board is really happy that the stock market has recovered. They continue to incent the investment community to buy, for lack of a better word, risky assets. That meaning equities. I don't think Ben Bernanke is as happy as he'd like to be, but he's certainly pleased that the market has appreciated to take some of the tension off of the economy, from houses, jobs, to at least people have been able to look at the stock market.